Semiconductors plunge U.S. Stock market triggers chain reaction. What is the real truth behind it? Brothers and sisters, big news hit the U.S. stock market again last night. The semiconductor sector took a sharp dive, dragging down the broader market with it. A lot of folks might be thinking, isn't it just chip companies falling? Why would that affect the entire stock market? In fact, semiconductors aren't just tiny parts inside phones and computers, they're practically the heart of the modern economy. And when this heart runs into trouble, it sets off a chain reaction across the board. Hi everyone, I'm Chinking, a seasoned stock investor with over a decade of experience in the US market. In today's video, I'll break down this wave of semiconductor-led decline and the broader market fallout in the simplest way possible. We'll dive into the deeper logic behind the scenes, and more importantly, what it all means for your next moves in the market. I'll also help you rethink and reorganize your investment strategies. Before we dive in, do me a quick favor, leave a comment with your thoughts. And if you find my videos helpful, feel free to subscribe for free. Your support is what keeps me going with more in-depth analysis. First, let's take a look back at the broader market. Today, all three major U.S. indices ended in the red. The S&P 500 closed down 41.6 points, a drop of 0.64%. However, for the week, the S&P still posted a slight gain of 0.1%. From the daily chart, the index is moving in an increasingly flattened upward channel. At this rate, future upside looks quite limited. It's almost like the market is just shuffling in place day by day. The core reason behind the market's weakness is that it's been climbing for too long and too high without any proper correction. Naturally, investors start to worry. Could a sudden big drop be coming? After all, an index can only do three things: go up, move sideways, or go down. And when it's stuck in a sideways range for too long with no momentum, that's when a black swan could swoop in and trigger a sharp fall. As for the idea of timing the top, I've always said that's basically impossible. Selling at the top usually just means you sold early and the market kept rising, and you missed out on further gains. Timing the exact top is more luck than skill. If you're truly feeling nervous about current highs, a more practical approach is to gradually reduce your positions. This helps ease the psychological pressure, lets you lock in some profits, and keep some cash ready for future rebalancing or buying opportunities when the market dips. Now let's talk about the Nasdaq. Today, the Nasdaq fell 249.61 points, a drop of 1.15%. This rally started from the Trump-era tariff bottom and has since surged over 6,000 points, a gain of more than 45%. But at this point, the index has deviated significantly from its long-term moving average. With such a large gap, high deviation rate, the momentum for further strong upside is limited. After all, even stock indexes are bound by gravity. Either the long-term moving average catches up slowly over time, or the index needs to pull back before resuming the climb. Now, let me update you on my public account. As of this week's close, the net value stands at $171,000, with a loss of $2,264 today. Still, there were some highlights among individual stocks this week. For example, Google hit a new all-time high, bringing in an unrealized profit of $14,000. Two other stocks, Reddit and Tesla, each posted gains of over $10,000. Reddit was especially surprising. The position was so small I almost forgot about it, but it performed beautifully on its own, to the point where I didn't even feel like touching it. Of course, not everything went smoothly. For example, I'm still stuck in LNT. Though it's gradually recovering, it's only a matter of time before I break even. As for TLT, it's still in the red, but I'm not worried at all. This is a long-term holding. Give it a few years, and it'll eventually turn around. Today, the U.S. released its latest inflation data, the PCE Personal Consumption Expenditures Price Index. The numbers show that core inflation, excluding food and energy, seasonally adjusted, rose 2.9% year-over-year and 0.3% month-over-month, basically in line with market expectations. The overall PCE rose 2.6% year-over-year and 0.2% month-over-month, also matching forecasts. Many of you might know that the U.S. releases three main inflation indicators each month: CPI, PPI, and PCE. But the most important one is PCE, and the reason is simple. The Fed watches core PCE most closely. Every time Jerome Powell says the goal is to bring inflation down to 2%, he's referring specifically to core PCE. Looking at the breakdown, core goods prices were flat month, but core services rose 0.36%, which was the main driver behind the increase in core PCE. In other words, the rise in prices during July wasn't due to tariffs, but because service prices went up. Interestingly, even though the data came in exactly as expected, the U.S. stock market still came under pressure afterward. The market opened lower and kept falling. Within the first hour, it dropped quickly. But think about it, core PCEO only rose 0.1% more than June and is still far from the Fed's 2% target. Everything was basically priced in. This alone shouldn't have triggered a... So today's drop likely has a deeper reason, which I'll discuss a bit later when I share my personal thoughts. Meanwhile, there was a major signal from inside the Federal Reserve. Christopher Waller, a dovish official known for openly aligning with Trump and one of the frontrunners for the next Fed chair, said that the Fed should cut rates by 25 basis points in September and follow up with more cuts over the next 3 to 6 months. His reasoning, inflation is now close to 2%. The labor market is cooling and job data is weakening. From a risk management perspective, the Fed should lower interest rates sooner rather than later. Another report from Reuters is also worth paying close attention to. The Federal Reserve's reverse repo balance is nearly depleted, signaling that the balance sheet reduction quantitative tightening has entered a new phase. So, what exactly is a reverse repo? Simply put, the Fed borrows money from the market by using U.S. Treasury bonds as collateral. That's called a reverse repo. On the flip side, when financial institutions lend their idle cash to the Fed and receive treasuries as collateral, that's a regular repo. For reverse repo operations to work, the Fed needs to have enough treasuries on hand to offer as collateral. This process allows the Fed to drain money from the market, helping keep interest rates within the target federal funds rate range and reducing excess liquidity. You can think of treasuries as the fuel for the Fed's liquidity pump. Without enough treasuries, the pump can't function, now that the reverse repo facility is nearly empty. It means the Fed's pump is running out of gas, which will have far-reaching effects on market liquidity going forward. To sum it up, inflation data met expectations, but markets still fell, indicating hidden factors are at play. The Fed is now sending clearer signals about potential rate cuts, with dovish voices growing louder. The reverse repo balance is drying up, and the liquidity environment is shifting in subtle but significant ways. We know that the Fed has been engaged in quantitative tightening QT for 3 years now, steadily shrinking its balance sheet. As a result, the Fed's total assets have fallen from $9 trillion in 2022 to about $6.7 trillion today. I had previously predicted that the Fed might stop QT this summer, since it needs to maintain a sufficient level of central bank reserves. But now, market analysts believe QT could continue until early next year. Reuters pointed out that the Fed's reverse repo ammunition is nearly exhausted, and this directly challenges the sustainability of quantitative tightening QT. If the Fed continues to reduce its assets, it will have fewer bullets left to influence both short-term and long-term interest rates. So it's reasonable to infer that the timing for the Fed to end QT might be drawing closer. At the same time, another piece of news has dominated financial headlines for several days this week. Trump wants to fire Federal Reserve Governor Lisa Cook. The trigger: in 2021, Cook used to separate homes as collateral for mortgage loans, claiming both were her primary residence. Trump seized on this issue and called for her resignation. But we all know the deeper reason. Trump wants to gain control of the Fed's Board of Governors. The Fed's independence has long been considered one of the pillars of market stability, and now that independence is under pressure. While the Cook incident hasn't directly triggered a market crash, many economists are already concerned Trump's growing influence over the Fed could create serious market volatility in the future. Some of you might be wondering, why is it the Fed chair and voting members who set monetary policy? Why not just let the president decide? Is there really a big difference in who handles monetary policy? The answer lies in the fundamental difference between technical bureaucrats and political bureaucrats. In the structure of government, the Federal Reserve is supposed to be run by technical bureaucrats, experts who rely on professional knowledge and rational analysis. They're not elected, and their terms often span across different presidential administrations. The whole point is to shield monetary policy from political pressure and ensure objectivity. Political bureaucrats, on the other hand, are always focused on elections. Their thinking is often short-term, and they're more likely to sacrifice long-term stability in order to win votes. If monetary policy were directly controlled by them, inflation could easily spiral out of control. If you agree with my analysis, don't forget to like, subscribe to my channel, and share your thoughts in the comments. Historically, there's a cautionary tale. In the 1970s, President Nixon pressured the Fed to cut interest rates despite high inflation and high unemployment, just to help him get reelected. That decision left serious economic problems down the road. And here's the concern now. By next year, the Fed could go through a reshuffling, giving Trump the chance to gain majority control of the voting members. If that happens, we could see aggressive monetary easing in the short term, which might look like great news for the stock market. But in the long run, it could plant the seeds for major future risks. Switching gears, the U.S. trade deficit in July widened by 22%, with imports rising sharply. This signals potential downside pressure on Q3 GDP. The Atlanta Fed's GDP model now forecasts U.S. GDP growth could slow to 2.2% in Q3. Trump has pushed hard on tariffs, yet ironically, the trade deficit keeps growing, especially imports. And in GDP calculations, imports are a negative factor. The more you import, the more it drags down GDP. Back in Q1, the U.S. even reported negative GDP growth, largely due to a surge in imports. From a macro perspective, slowing GDP is clearly a warning sign for the economy. And that's a bearish factor for the stock market. But the big question remains, why exactly did U.S. stocks fall today? Looking at the sector heat map, the worst hit sectors were semiconductors, semiconductor equipment, and auto manufacturing. Among them, semiconductors are a key heavyweight in the index. So when they fall hard, they drag the entire market down with them. So why did the semiconductor sector crash? It all came down to a single piece of news from Alibaba, the straw that broke the camel's back. Alibaba reported earnings showing 2% year-over-year revenue growth and a 78% surge in net profit. But that profit jump came mostly from a one-time investment gain, the sale of its Turkish e-commerce subsidiary. As for core operations, Alibaba Cloud grew 26% YoY faster than the previous quarter, driven by strong AI-related demand. But what really spooked Wall Street was this. Alibaba is developing a new AI chip aimed at filling the gap left by NVIDIA, which is now restricted in the Chinese market. Even more significant, this chip won't be manufactured by TSMC, but by a Chinese domestic foundry. At the same time, Chinese chipmaker Cambricon Hanwugi has seen its A-share stock price skyrocket. Orders for its AI chip business have surged, and profits are up more than 40 times year. If China's semiconductor industry can truly accelerate its catch-up, then the U.S. semiconductor sector is under major threat, and that's why Wall Street is reacting so strongly. Of course, industry experts also point out that China still has a significant gap to close before it can produce chips that truly rival the most advanced American technology. On the other hand, NVIDIA, the leading name in semiconductors, delivered an almost flawless earnings report this week. Revenue and profit both beat expectations. And guidance for next quarter was also better than forecast. But here's the problem. All that perfection had already been priced in. On the day of the earnings release, NVIDIA's stock actually fell 0.79%, and today it couldn't hold up any longer, plunging 3.32%. Market expectations for NVIDIA have been sky-high, but when a stock is already priced for perfection, even stellar results may not be enough to satisfy investors. When the market leader starts to turn down, especially in a sector as heavily weighted as semiconductors, it naturally drags the major indices lower. Another sector that saw significant losses today was automotive, with the main drag coming from Tesla. While Tesla stock has been moving in a choppy pattern, the overall trend is still slowly upward. However, it hasn't shown any signs of a strong rally. Going forward, the stock will likely continue its slow upward grind. But for investors, the experience may feel underwhelming. That's because Tesla's recent earnings reports have been mediocre, and there hasn't been any major positive news to push the stock significantly higher. In fact, a survey conducted in August shows that consumers aren't necessarily more inclined to buy Teslas because of FSD full support. Only 14% of respondents said FSD would increase their desire to buy a Tesla. Meanwhile, 35% said FSD would reduce their willingness to purchase, and 51% said it would have no impact at all on their decision. Of course, the results of such surveys depend on the sample selection and may not fully represent the broader market. Still, if Tesla's stock isn't likely to rise sharply in the short term, frequent trading may not be worth it. In such cases, it might be better to simply hold the position and wait for the trend to develop naturally. That's it for today's episode. Quick reminder, U.S. markets will be closed next Monday for Labor Day. So enjoy the long weekend and take a well-deserved break. Alright, that wraps up today's video. If you enjoyed it, don't forget to give it a like, subscribe to the channel, and leave a comment below. Would FSD make you more likely to buy a Tesla? Or does it have no effect on your decision at all? Let's talk about it. Thanks for watching, I'm Chinking, and I'll see you in the next episode.